So I would prefer to wake up, I think, on my birthday to have the market up. But if you've got some cash, things are starting to look very, very cheap. And I'm starting to think maybe I might have got these boots for my birthday so I can kick some ass in the markets in the second half of the year. Welcome to this week's Money Market Update. So the Dow Jones has had a 900-point drop, which is one of its biggest one-day declines since 2020. And this is the third consecutive week for the S&P that it's closed lower. When you think about it, and when you look at what's been going on for the last 2 years and what is going to happen going forward in the next 18 months to 2 years, there just simply has to be a revaluation of asset prices. We've essentially had interest rates at zero for 2 years now, and arguably in some parts of the world, zero for more than 10 years, particularly in Europe. And asset valuations have got overpriced when there's free money around, when central banks are printing money, when governments are stuffing that money in the back pockets of citizens around the world. You know, you look at Australia, the United States, bank accounts right now are swelling. People have been buying assets, asset valuations have been skyrocketing. And what we have right now is, as the pandemic is winding down, you've just got this massive demand. So when you have central banks printing money, interest rates at zero, government stuffing that money in the back pockets of citizens, you then actually restrict their movement, and then all of a sudden everything opens up, you have rampant inflation. And what central banks are doing right now is they're tightening interest rates because they just simply must curb the demand. And interest rates are going to go up, and asset valuations that have gotten too far ahead of earnings, bottom line profits, with the expectation of what's going to happen in the future, everything is just simply being revalued right now. And now is not the time for anyone that owns quality assets to go adjusting a portfolio or jettisoning those assets from their portfolio, provided they own great quality businesses like our portfolio here at Trading Mastery. If you own businesses that don't make money, penny dreadfuls, companies that have got a lot of debt, etc., that will find it more difficult to service that debt with interest rates being higher, then you're going to get screwed. Your share prices are falling like a rock. And you know, even businesses like Netflix that we've seen fall, a huge amount in valuation in the last couple of days, it's a wonderful business. It's going to continue to make money long term, but it's not going to have the same subscriber number growth that it's had in the past few years. So the market is revaluing that business and saying, hey, you're not going to do as well as what you have in the last 12 months. So everything that we're seeing right now is a natural reaction to what we've seen with monetary policy, government spending money on stuffing bank accounts with money, and massive demand. So that's where we are right now. And if you have some cash, you should be smiling today. I mean, I know I opened up this piece today by saying that I'd much rather see share prices up. But to be quite frank with you, those of us that have got some cash on the sidelines, that have an income stream, that have got the ability to continue to buy shares, you don't want to see share prices go up all the time. You want to see them decline every now and again, so as you can actually buy some quality assets at some really discounted prices. I mean, we bought, all through this year so far, January, February, March, and April. I bought some more shares this week of some companies, and we will continue to buy, because for those investors that go, oh yeah, but prices are going down, I'm going to sit on the sidelines and I'm just going to wait, and I'm just going to wait until things get better, and then I'll put my money to work. That is not the way to invest if you're a retail investor, because number one, you will not time the market well enough to do that. It's been absolutely proven over time that anyone who tries to time markets in that respect, they're going to lose out with respect to their opportunity. Just look, always look to the business. Look to the business, and what is that business going to be producing in the future? Forget about the share price today. Forget about the share price. Think about what that business is going to be earning in 2, 3, 5 years from now. And if that business is continuing to make money in 2, 3, 5 years from now, and its share price is discounted 25, 30, 40%, then hello, that is a wonderful buying opportunity that you should participate in. Not thinking, well, I reckon I can pick the lowest point in the coming 3 to 6 months when markets have bottomed, and then I'll put my money back in, and or even worse, you put your money back into the market when everything is starting to rise. I guarantee you, you will underperform by trying to do that. You have to be prepared to step up to the plate when everybody else is selling and you start to buy. But the key is you've got to be buying the right assets, quality assets, and of course, those of you at Trading Mastery, you know what they are. You know, it's not rocket science, it's actually very simple, but so many people don't understand the process to building long-term wealth. And right now, 2022 is going to be, I can tell you now, when we look back in 3 or 4 or 5 years from now, people that did not buy in 2022 and they sat on the sidelines, they're going to look back as they did in 2020 and they're going to say, gee, I wish I had have actually bought some shares then. All right, so the Aussie dollar has had its biggest one-day decline in 18 months, down 1.5%. In fact, the Aussie dollar fell about 1.5 cents through that US trading session. Why? Because the US dollar acts as a safe haven asset in times of volatility. Anyone who owns US dollar assets right now, your share portfolio, even the US markets went down and your share prices went down. I bet you if you look at your portfolio this morning, your portfolio didn't actually adjust that much because the Aussie dollar declined, US dollar rallied, and your assets are based in US dollars. So some of you might be saying, well, AB, you didn't mention anything about earnings season. And you're right, I didn't. I want to mention that right now because earnings so far for Q1 2022 have been average. We've had some companies outstripping expectations to the upside and giving great forward guidance, such as airlines, cruise lines, hotels, a lot of travel and leisure companies reporting good, strong earnings and also forward guidance. And then we've got a lot of other businesses on the flip side of that reporting weaker than expected earnings, Netflix, etc. And we're seeing their share prices crushed. Here's the bottom line. When we see interest rates rise, if you own businesses that don't make money, and there are plenty of listed businesses around the world that don't make money, and a lot of people actually buy them not even knowing that they don't make money. If you own those businesses, you're going to see your portfolio crushed in the next 12 months. You need to own quality assets. Now, in the next week, we're going to see 2 of the biggest businesses in the world report their Q1 earnings, and it's going to be critically important for the short to medium term price volatility in US and global markets. And I'll tell you what those 2 businesses are, Apple and Microsoft. Right now, Apple and Microsoft are likely going to produce earnings in the Q1 quarter that is probably going to meet the market's expectations. I would be hard pressed to see them bringing in earnings expectations or earnings that below the expectations. But here's the thing to watch. Even if they beat market expectations next week, if the market doesn't grab a hold of the share price and start to move it higher and they sell it off, when you look at 25% of the S&P 500 is Amazon, Apple, Microsoft, and Alphabet. If those businesses cannot hold up and start to capitulate, we could see markets even significantly lower than where they are now. I'm talking about the NASDAQ down 25%, the S&P 500 maybe down somewhere between 12 and 15%. That would create some enormous bargain bin pricing opportunities in my view, because we don't buy shares to speculate to see what's going to happen in the next 6 to 12 months. We buy shares in great quality companies and we look to the business to grow into the earnings to see the share price rise over time. And I can tell you, anybody looking to try and speculate in markets and make money in 6 to 12 months, the probability of you doing that successfully and making anything meaningful, you might be able to stick your hand up and say, yeah, I made a few $1,000, but I'm talking about tens of thousands, hundreds of thousands, and over time, millions of dollars. You've got to be prepared to step up, buy great quality assets when they're cheap, and then hold on to them. You know, the average person, did you know the average person today that participates in the share market, how long they hold a company for? 3 months. 3 months. That is extraordinary, and that tells you exactly the reason why The average investor in the share market doesn't make money because they're speculating on price and they're not focusing and buying the company and the earnings in that business over time and just sitting on their ass. As we have done for the last 2 years at Trading Mastery, and our portfolio is still up over 80%. Have an awesome week, guys. Keep up to date with me on all the social media channels, Facebook, Twitter, you name it. Look it up. Let's keep the ball rolling. I hope you have a wonderful weekend. I'll see you next time.